What is going on, traders? Welcome back to the Traveling Trader. Happy Monday to you. A lot to get into today. I wanted to go over the S&P 500. I'll give you my market overview. And then obviously big news in earnings this week. A lot of major stocks are reporting earnings this week. I'm talking about the $1 trillion club, of course, Microsoft, Apple, Amazon reporting earnings this week, as well as some other ones. We have Facebook reporting earnings this week, Boeing, Tesla, AMD. And I'm going to show you what is the best earning strategy, or one of my favorite earning strategy, how to play earnings, especially if you don't want to guess a direction in, whether the earnings is going to drive the stock up or down. And this has an 80% probability of success. Also, what stocks to buy, if there is any that you should be adding this week, right? We'll go over that. What stocks to buy. Last week we played the Netflix earnings beautifully. I'll go over that play, and then we also played the SPY options. And obviously, when I talk about the S&P 500, I'll go over that as well. But I'll go over the Netflix options play from last week and why I shorted oil. So I'll take a look at the oil futures and how that's actually looking at that right now. Let me take a look at what the price of the oil futures are. So I shorted oil at $17. It is now $12.30. So up big time on the short here on the crude light oil futures, or light crude oil futures, I should say. So yeah, we'll take a look at oil futures and the different ways that you could play that. So without further ado, let us get right into it. Looking at the S&P, this is the S&P futures. Let me just switch, because when I started the video it was pre-market, but let me just take a look at the actual S&P now that the market is open, and I'll give you my take on it. So looking at the S&P, we obviously closed above the 50-day moving average. On my chart, it's the orange line here. With the earnings this week, I don't see there being a lot of weakness, especially since some of the companies that are reporting earnings are impervious to what's going on with regards to the pandemic, right? When I'm talking about Microsoft and Amazon specifically, Apple obviously is affected because of the supply chain in China. Tesla is the interesting one. And when I go over the earnings strategy, that's one where I think the earnings strategy that I show you will apply really suitably to Tesla, because that is one where I just don't know what's going to happen at earnings. But you see the 100 MA flirting with crossing below the 200 MA. This is called a mini death cross. Not as significant as the death cross that happened here between the 50 and the 200. So where do I think the S&P is going? Well, if you followed the trade alerts from last week, and if you want access to the trade alerts where I send out all of my options plays, what I'm doing in the market, where I send out my stock alerts, even crypto, link is in the description. But this is why I booked profits on the SPY trade last week. So if you look at the SPY, you'll see that there was a sharp price increase and just a decline in volume, right? This is something that you don't want to see when you're bullish on a stock or on a commodity. You don't want to see this, because this is a kind of divergence. It's telling you that the price is going up while the volume is going down. And that is one of the telltale signs of a dead cat bounce or a weak rally of sorts. And then we had the hidden bearish divergence, right, between the price, the RSI, the MACD, where the price is making a lower high and the momentum indicators are making higher highs. And then lastly, we have this level here. Well, not lastly, there's a couple more things. You have the 50-day moving average, again, the orange, and we had the 0.5 fib level sitting right around here. So you have a confluence of indicators telling you that there could be some weakness. And then obviously, earnings, the earnings this week, last week doesn't even compare to the companies that are reporting earnings this week. So you have to take the fundamentals into account as well, right? And the fact that the market is definitely waiting on these $1 trillion companies, Microsoft, Amazon, and Apple, to report earnings, as well as Facebook, as well as Tesla. I mean, the biggest companies on the planet are reporting earnings this week. So the market is clearly waiting for that. And if you look at last week, we sweated it out a bit. I mean, I could have closed it earlier than expiration, but if you look at last week, it expired, or it closed at 282.97. I needed for it to close below 284, and thank God it did. Collected the entire amount. So where do I think the S&P is going? In the short term, I do think we will have a green week, and that is because of all of those companies that I was talking about reporting earnings. And in terms of where it can rise to, I mean, 300 is not actually unrealistic. You have this resistance cluster here between the 100 and the 200, just above where the 0.65 fib level is. Did I say 300? I meant 3,000, switching back between the SPY and the actual S&P. But, the 3,000 level, and it's a psychological level as well. However, you do have this resistance here to contend with, but it's not that far up. So, between where we are now and that resistance is only, in terms of percentage points, you can measure it in TradingView, but it's only 1%. So if you're saying that the S&P can't go up 1% and potentially break this resistance line with all of those companies reporting earnings, some of which will probably be very positive, like I said, because their business models are impervious to the pandemic, I think it's very plausible that we break this resistance level and break it rather easily. And we'll see a price level between, let's just say the 0.618 right now is sitting at 29.33 and 3,000 for the S&P 500. I would feel very comfortable buying puts or selling calls at the 3,000 level or the 300 level. If we're talking about the SPY, I'd feel very comfortable selling calls or buying puts at this level, because apart from all the technical indicators, it is a psychological level, right? It's a round number, that 300. And the fact that we still have all these things going against it, right? I mean, once all those earnings are out of the way, then you still have to contend with all of these market forces that I'm discussing here. So I do think that we'll see a cap at around the 300 level on the SPY. And I will be sending out my trades for this, exactly how I'm going to be playing the SPY and when. I'll be sending that out in our trading group. The link is below. Now, in terms of longer term, will we see a V-shaped recovery? Well, I think it all hinges on, from a technical standpoint, if you look at it, it really all hinges on the 21 weekly EMA, which is this white line on my chart here. And the reason I say that is if you take a look at the 21 weekly EMA, that's usually, anytime we've had a correction or a crash, that's usually the first indication that the market is ready to rally. Here you see the dip, the correction in the end of 2018, where, we thought we were going to possibly be entering a bear market, but we stopped just shy of that, bounced off the 200 weekly EMA. And once we crossed above the 21 weekly EMA, it was really, all bets were off, and we were able to continue the bull rally. Here in 2015, you see the 21 EMA. This was kind of a W-shaped recovery, and I think what most analysts are expecting for this, because what's happening right now is unprecedented. However, I will say that every market correction or every market crash, there aren't two that are exactly alike. And currently we're in an unprecedented situation with the pandemic, so the reaction to it is going to be unprecedented as well. But you see the 21 weekly EMA here, we popped above it, and then we retested close to the 200 weekly MA before popping above it again. So 2015 was kind of an anomaly. But if you take a look at, 2011, when we had our correction here, once we popped above the 21 EMA, it really was the signal that the market was ready to start the bull rally again. And then obviously the 2008 market crash, when you take a look at this, by 2009, once we crossed above the 21 weekly EMA, all bets were off again. So I think the 21 weekly EMA is a great indicator of strength on the weekly. And you'll see here that currently the 100 MA is where the 100 weekly MA is currently where we're finding resistance. So if you do get to that 300, the SPY will obviously have to cross above the 21 EMA and come right up to the 50 weekly MA. And we want to see a few candles, how it responds to this. And if it falls back below, then we could start talking about a W-shaped recovery. Obviously, coming up here in the next couple months, some of the economies are going to be opening up in a limited capacity. A lot of the businesses that were dormant, such as airlines, right? We're going to be seeing limited flights, probably social distanced flights where every other seat is sold or something like that. How's the market going to respond to that, right? Like, obviously we'll see a surge initially once the economies start opening back up, just due to the hype. But then when everything sets in and everyone's counting their losses and the effects of what this pandemic has done to their business, you might see a quelling effect where reality sets in and companies start to realize that they're not in a great position in the midterm, and we could see a W-shaped recovery. I actually don't think that anybody knows, but as traders, I as a trader, I really don't care, right? Like last week, I was very comfortable selling these credit spreads against the SPY. This week, not so much, because all those companies that are reporting earnings. You have to trade what the market gives you. On the way down, we were shorting the obvious plays, right? Shorting the cruise lines, shorting the airlines. Those were the obvious plays. Shorting the hotels. And then the week of the stimulus bought up all of the blue chip companies that we could buy, right? Microsoft, Shopify, Nike, Tesla, Home Depot. Bought all those companies at March 23rd when the week of the stimulus. It's not like we were bottom finding. If you're not new to this channel, you know that I'm not a fan of trying to catch the bottom at all. But I knew that the week of the stimulus was probably a good stopgap and a good chance to pick up some blue chip stocks at a discount, right? I mean, anytime that I can get Microsoft at a 30% discount, you're going to have to kill me for me not to take advantage of Microsoft at a 30% discount. And every week we're taking a look at the market, putting in our options plays, our stock plays. And, you know, I'm not, there are some people that are pissed, right? That the market is looking like it's doing a V-shaped recovery. Again, nobody knows, but it looks like it's recovering faster or a lot more significantly than it should, considering the circumstances. And some folks are pissed about that for some reason. However, you know, you kind of have to be emotionally neutral and just trade what the market gives you. All right, let us talk about the earning strategy. So this earning strategy will net you, well, obviously it's not a guarantee. Nothing is guaranteed, but based on the calculations that the exchange, that the broker, in this case Thinkorswim, based on the calculations here, there is an 85% chance that we will end up at break even or in profit using this strategy here. And for those that are new to options trading, this is called an iron condor, right? So it's basically a series of options where you're essentially selling a call and you're selling a put, and then you're capping it on the ends here with these wings by buying a far out of the money put and a far out of the money call. That's how you get these caps here. Otherwise, it would be, you know, a strangle or a straddle, depending on where your strike prices are. But essentially, you want to cap this risk here. And if you take a look in a platform like Thinkorswim, you know, selling 10 of these iron condors at the price of, what was this price? $2.73, right? You're essentially getting $2,730 up front. There's an 85% chance that you end up at zero or above. Now, obviously, perfect scenario based on the strikes that I picked, that if Microsoft closes below 185 or above 165, I get to keep $2,730, right? And I need it to close above, you see these yellow lines here. These are the break-even points. So I needed to close, you know, below 187.73 and above 162.25 in order for me to break even. Anything below that, we start talking about losses, and anything above 187.73, we start talking about losses as well. But my losses are capped. So I'm almost, well, it's better than 50-50 because I'm collecting $2,730 up front for the full credit, and I just needed to be in this range for me to keep that entire amount. And down here is where we would suffer max losses. At anything above 190 or below 160, we would lose $2,270. Now, I don't need to tell you, options trading is obviously risky. You have to know what you're doing. This is an rather advanced options strategy if you're new to trading options and all you're doing is buying calls or buying puts, or maybe you've transitioned on to doing verticals. But this consists of 4 option legs all in one order, and this is called an iron condor. And this, you know, especially with, I also do have a call debit spread on Microsoft as well that I set up. That one's at 172.50 because I do have a bullish bias with Microsoft, but I hedged it with this iron condor as well to collect that $2,730 credit up front on 10 contracts. And the reason that I'm comfortable doing this on a stock like Microsoft is because Microsoft doesn't really move that much even during earnings season. If you take a look at the earnings tab here in Thinkorswim, it shows you all of the previous earnings, right? You have Q3 2018, Q4 2018, Q1 2019, et cetera, and we're over here. But you'll see exactly how Microsoft responded to earnings. The dotted line here in the middle on each of these is when Microsoft reported earnings, and you'll see the price candle right when Microsoft reported earnings, how implied volatility changed, and then down here you'll see whether Microsoft, how many times it beat earnings. And out of the last 1, 2, 3, 4, 5, 6, 7, 8 times, 7 out of the last 8 times Microsoft beat earnings. But you'll see how the price reacts whether it beats or misses earnings. And you can click in any one of these columns and take a look at the price increase or the price change after earnings, right? And it's usually within, $5 to $10. It's not that drastic. And then up here on Thinkorswim, you have this thing called the triple M. I think it stands for market maker move, but it basically tells you what is expected in terms of a plus minus, right? The move that's expected for Microsoft, and it reflects exactly what I was talking about. So whether it misses earnings or not, or goes down or up during earnings, the expected move is below $7 in either direction. So when you take a look at my trade here, you'll see that, Microsoft, like I said, has, in this case, has an above 85% chance of at least breaking even. And we're talking about $7 in either direction, but I'm well protected because, currently Microsoft is at 176.01, and I just needed to close below, 187.73 or above 162.25. So I really like this trade. And if it starts to go awry, obviously I can make adjustments, maybe roll it out a further week, because this expires this week, but I can roll it out by a week or two, depending on what Microsoft is doing. But it is reporting earnings on Wednesday after market. Now, this is one where I'll definitely take this approach with Tesla, because looking at Tesla, I haven't yet opened a trade on Tesla, waiting to see how crazy the price will get before opening a trade. You can see that it's up to 782 right now, which is just insane. So sometimes you want to see, you want the market to make these moves before entering an an earnings trade, right? Because it can move hyperbolically. During earnings week is when you tend to get a lot of volatility, depending on what we're talking about. And if we look at Tesla's volatility right now on the options expiring May 1st, it's the highest, obviously, out of any of these option chains. We have almost 150% volatility. And right now, Tesla's current implied volatility overall is 104%. So it's almost 50% greater than what it normally trades at. So with a high volatility stock, sometimes you want to, give it some time to do what it does before earnings, before putting in a play. But if we take a look at Tesla's chart, you'll see that, this is the 15-minute. Let's just take a look at the 1 day real quick. But you'll see that Tesla had this insane rally, formed a bull flag, and is now climbing up to near where there looks like there might be a resistance around here based on previous levels. Tesla's up 7% today. So if you did a play similar to what we saw with the Microsoft play before, if you did that play on Tesla prematurely, you would have been sweating it out right now, because Tesla just had a big move, as we saw on a Monday, right? It's up almost 8% in 1 day. All right, so that's how I play earnings, right? Especially when you don't want to pick a certain direction for the stock. Iron condors, look into them. If you're new to options, look into iron condors, exactly how to set them up. Please do paper trading beforehand. If you're new to options, don't jump into it. The market is always open. There's always going to be opportunities. So don't jump into it. In terms of stocks to actually buy just on the spot market, I do think that there are some stocks that are, now have passed you by. If we're talking about the short term. So if you're talking about the Amazons, if you're talking about the Microsofts, if you're talking about Tesla even, I don't think those are good buys for the short term. I mean, Amazon is trading at all-time highs right now. Again, I was able to pick up Amazon during the week of the stimulus. I actually sent that out in the trade alerts. You could see the history of the trade alerts. You're part of the trading group, but this was everything that I picked up during the week of the stimulus. It was, Shop, Tesla, Visa, Amazon, Microsoft, Google, Home Depot, Delta, Nike, Apple. I picked up some silver, McDonald's, and JP Morgan, as well as Lululemon, American Airlines, CVS, Bank of America, and Wells Fargo. But if you take a look at some of those stocks, I do think that they're not at optimal levels to enter. Something like Microsoft, if you're talking about 5 to 10 years, yes, of course, then it's a growth stock that you'll want to add to your portfolio, because if you take a look at something like Microsoft historically, it's just an exponentially gaining stock over the years. But when I saw Microsoft trading at a 30% discount, I picked it up because it's one that I've been waiting for a retracement for a very long time. And I didn't care whether it was the bottom or not. I like to trade with certainty. What was certain was that Microsoft was at a 30% discount. What's uncertain is whether that was the bottom or not. And I don't concern myself with bottoms during market crashes. When I see undervalued blue chips, I pick them up. It's not like we're trading startups here, right? We're talking about Microsoft, we're talking about Amazon, we're talking about Nike and some of these other companies. So, that's essentially why I really don't care whether it's the bottom or not. And if Microsoft starts dipping further, then I'll buy into it again. Since the week that we bought it, we're up now around 28% on Microsoft, which is not too shabby in a market crash. But I said this before, there are still some stocks that are near their market crash bottom, right? Obviously, all the airlines. Think about when the airlines start opening back up for business. Do you think that what you're looking for are anomalies, right? So if this is the normal trading range for Delta Airlines, let's do something like a regression trend. But if this is the normal trading range for Delta Airlines, let's remove you know what I mean? Where it trades in a tight range, let's say going all the way back to 2016, it's trading in this tight range that's gradually ascending. But then you see a market crash like this, then obviously this is an anomaly, right? This is not Delta Airlines' normal trading range, and this is due to the current situation that we're in. So Delta is still at the lows that we saw during the week of the stimulus. It did see a rally, got hit by the 21 EMA and retraced again. So there are still some really lucrative long-term stocks to pick up. One that I'm really looking at in terms of earnings this week is Boeing, looking to see how Boeing responds to earnings. If Boeing falls below $100, then I'm definitely going to pick up Boeing for the long term. Disney, it was one of my favorite stocks during the bull rally, right? If you take a look at Disney, I mean, you're talking about one of the most valuable media companies on earth, if not the most. And currently it's hamstrung by the 21 EMA here. So, and Disney earnings, actually, do they report? Okay, they report next week. But yeah, I'll definitely wait for Disney earnings, or I might play the earnings play in the similar way that I'm playing Microsoft. We'll see. Just look out for Disney alerts in the trade alerts. But, I'm definitely looking to pick up some cheap Disney. Another one that I really like is Booking.com. If you look at Booking, obviously the travel industry right now is taking a hit because it's dormant. It's non-existent. Nobody's traveling. But Booking was one that, again, had this really high price trading range, trading between 1,600 and 2,000. And if you look at the lows that it's in, you're going to have to look at the weekly just to get a sense for it. But, it's currently trading at 4 or 5 year lows. So I'm happy to pick up Booking here for the long term as well. Now, it's not going to see a snapback rebound in the same way that Microsoft did or Amazon did. I mean, if you look at Amazon's chart, it was actually crazy that you could buy Amazon for, almost $1,600, and now it's trading at $2,400. And this is just in a matter of 5 or 6 weeks. All right, we'll take a look at the Netflix options play just as an example of what I did last week. Was actually sweating this out a bit, but Netflix reported earnings last week, and they just missed in terms of earnings per share, but they added way more subscribers than expected. But if you take a look at Netflix, it already had its rally coming into earnings, forming sort of this bull flag here, but it already had its rally coming into earnings, so I didn't expect the price to make a major move after that. And instead of doing an iron condor, which I could have done, I basically just sold, put credit spreads at 420. So if you take a look at the trade, you'll see here, I did it on April 20th, and the credit spreads were at 420 and 415. I got a pretty decent credit on it. Volatility wasn't that high. So, I did get 220 out of a potential $5, right? Because the difference in strikes is the max that the spread can be worth. If you take a look at Netflix's price, then this was after that rally. I was very comfortable doing this at 420. All right, and lastly, I'll go over oil. I shorted oil. I shorted the crude oil futures. Now you could do with futures, and I did a video on this, so I'll link it here. Specifically regarding oil, but you can either play futures, you could play, there's obviously leveraged ETFs, but you can also play options on the futures. And I shorted oil at $17. I sold the $17 call spread, and now oil is trading at $12. But the reason I did that is because, you know, when we took a look at the new contract for oil, it opened up at around $21, and it started tanking right after that. If you remember, the previous contract was the one that went to a penny and eventually below zero, because there's literally nowhere to put oil. There's so much supply. There's so much of a glut. There's nowhere to put the oil. Well, those circumstances aren't going to change a week later. So just because the next futures contract opened up at 20, once I started seeing it tanking, right, I looked at the $17 price point. If you take a look at it here in Thinkorswim, it started tanking and it was rising, and there were a few, this is a suckers rally, there were a few people that got sucked into this longing oil here for some reason when the circumstances haven't changed. If you take a look at oil, it's just sitting around. I mean, there's even talks of some countries burning the oil because they have nowhere to put it. But you know, the circumstances haven't changed at all. There's extreme weakness in the industry itself. There's an oversupply. Even if every country just stopped producing at zero, there's still nowhere to put the excess oil. They're sitting in tankers in the middle of the ocean. So when I saw that rally, I definitely shorted into this rally, and I saw that there was a couple of candles where it was finding resistance at $17. And that's when I shorted this current contract, and it's now down to 12. So we're up a good amount on this oil contract here. But go back and watch that video if you want to get a sense for how to play oil. There are different ways to play it with regards to futures, options on those futures, which is what I did. You could do it through oil ETFs, right? There's oil ETFs that trade. Some of them are leveraged, but they trade along with this oil futures, using oil futures as an index. I'll link that video here. Watch that. But essentially, that's exactly why we shorted oil here, because of that glut that's still existing. And until the economy rebounds and flights are starting back up, right? Because they use massive amounts of jet fuel and people are driving again, then we'll start to look at longing oil. But in this case, every time that we see oil rallying for no reason, just because of speculation, and you see the FOMO buyers jump in thinking that for some reason oil has to go up during this time. Eventually it will go up, but during this time there's absolutely no reason for it to go up. Then, you know, I'm going to be shorting oil each and every time, especially when you see the 21 EMA here as well acting as definitely as resistance ever since the pandemic. Right here we have January, and every time it comes up on the 21 EMA, you could see that is a very good point to short oil at. Anyway, that is it for this video. If you want access to my trades, the trades that I'm making, if you want access to the trading group where we discuss all of these things, options, stocks, crypto, even how to set up options trades, because it can be confusing, sign up. Link is in the description. Get active in the comment section. Let me know what it is you're trading, or if you have a question on any of these things, such as the iron condor or oil futures, for instance. This stuff can get confusing, so go ahead, feel free to leave it in the comment section below. I respond a lot of the time. Leave a thumbs up if you get anything out of this video. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.